Hello, this is one of the tutorial questions that you were taken through this week. I am not going to go repeating myself over everything that was done, except to just highlight them. So, just to explain a bit more. When you take question 2, for example, who acquired 80% of share capital of Huawei 2 years ago. 2 years ago. 2 years ago. When the reserves of Huawei stood at 2.5. Now, Ho paid initial cash of 20 million. So that will be your first purchase consideration element. First purchase consideration form, cash. Additionally, Ho issued 2 million shares with a nominal value of 2 cedis and a current market value of 3.6. The second one is direct issue of shares, 2 million shares, and you fair value it at 3.6. But when you are recording it, you must break it into the nominal of 2 and the share premium of 1.6 or other component of equity. It was also agreed that Ho would pay a further 10 million in 3 years' time. So we have deferred consideration. So in this question, you have cash, direct share issues, and then deferred consideration. So they will pay 10 million in 3 years' time. Cost of capital is 10%, but you've been given the discount factor, which is 0.751. So with all this information, you can calculate your purchase consideration. If you watch the earlier videos I sent, you realize that this calculation is given. You can do it. So it's just a reminder of what you are doing. All right. Now, when you move from there, you are given the financial statement at 31st December 2021. Okay, so there you go. Now, let's just talk about the footnote so I explain a bit further. At acquisition, the fair values of Huawei's plant exceeded its book value by 4 million. The plant had a remaining useful life of 5 years at this date. So this is one of the fair valuation of net asset acquired. So what this means is your share capital, your retained earning at acquisition, which is equal to your net asset. These two figures, which are your net assets. The implication here is that there are some assets that are not at fair value. Everything else is at fair value. The carrying value, the book value, is the same as the fair value. What it means is if the book says the plant, the property is 10,000, if you go to the market, you get it for 10,000. So that's what when we say the carrying value is the same as the fair value. However, if it is discovered that some of the assets and liabilities are not at fair value, then the acquirer must fair value them. So an example is the plant. It has a fair value which exceeds the book value by 4 million. And so it means we have to add 4 million to our carrying value of the net asset. Add, because there is a plant whose market value, fair value, is higher than the book value, and the parent must recognize assets at fair value, liabilities at fair value. So you add the 4 million to the net asset. That's what we normally call fair value adjustment. Fair value adjustment. Adjustment. And so if you have a plant and you fair value it, then it will also give you additional depreciation, because on the date of acquisition you acquired it. On the date of reporting, they would have used the asset for 1 year, and so they would have calculated depreciation. But because we are determining that there is fair value in excess, then we have to calculate an additional depreciation. And in this question, you must take note that because the acquisition was 2 years ago, that depreciation will be for 2 years. They will calculate the depreciation for 2 years. So we will have 4 million divided by 5 times 2 as our depreciation for the fair value adjustment. Okay, point number 2. For many years, Hopware has been selling some of its products under the brand name of Solom. At the date of acquisition, the directors of Ho valued this brand at 5 million with a remaining life of 10 years. The brand is not included in Hopware's statement of financial position. Again, if you read IFRS 3, they are part of the provisions of the acquisition accounting regarding assets acquired and liabilities assumed. Certain assets acquired, certain intangible assets acquired, which the subsidiary may not have recorded because maybe it doesn't meet the IAS definition of intangible for recognition. The parent on the date of acquisition is allowed, based on certain conditions, to recognize those intangible assets. IFRS 3, intangible assets. So when they meet the definition of separable, the parent is allowed to recognize them. So even though the subsidiary may not have recognized the intangible, the parent, if certain conditions are present, is allowed to recognize those intangible assets and fair value them. And so in this case, this brand, which is Solom, has not been recognized by the subsidiary. So it's not in the books, but the parent gets to recognize it because IFRS 3 allows it. So you have to go back and look at where or what IFRS 3 says about that. And then you recognize that brand. Again, it is an intangible asset. You amortize over 5 years. And because you are consolidating for 2 years, you will amortize for 2 years. You will amortize for 2 years. That amortization, it will be taken out of the 5 million when you are consolidating. The plant, the 2 years depreciation will be taken out of the value of the plant when you are consolidating. All right. Then the consolidated goodwill, this you know what to do. Once you calculate your goodwill, you charge impairment. Then whole values non-controlling interest at fair value. And you have been given the fair value as 20, at the date of acquisition, the fair value of the 20% non-controlling interest is 7.6. So you know what to do with them. So the only two things which I wanted you to be aware of is fair valuation of your assets and liabilities. Assets assumed and liability, assets acquired and liabilities assumed at the date of acquisition, and which means you have to fair value them and add them to your net asset. So when you go to do consolidation, this plant, this increase in the value of plant will be added to plant. So your total PPE in the consolidated financial statement will be 110,000 plus 30,000 plus the addition of the fair value. upward fair valuation, upward of 4 million. And then remember, you have calculated depreciation, 2 years depreciation. So you deduct that from it. So that's what will happen. You will introduce intangible asset into the consolidated statement of financial position. So you bring the 5 million less the 2 years amortization. You bring goodwill, intangible, okay, and then the rest, there will be NCI right after retained earning. So go ahead, you've been taken through at tutorials, do them again. And these are the reasons why you are doing what you are doing. Please always have an understanding of why you are treating a transaction in a certain way. And if you are in doubt, read the standards. What you do on the date of acquisition is guided by IFRS 3. What you do at the date of reporting is guided by IFRS 10, the consolidation itself. So take note of that. Thank you.